In this video, we will talk about scalping strategies in day trading. So make sure to watch the full video. Day trading, with its fast-paced nature and focus on short-term price movements, demands strategic precision and agility. Among the various techniques employed by day traders, scalping stands out as a nuanced and high-frequency strategy. This extensive exploration delves into the intricate world of scalping strategies, unraveling the complexities of execution, risk management, and the psychological discipline required for sustained success in the dynamic realm of day trading. Section 1. Understanding scalping. A quick overview. Scalping is a day trading strategy characterized by making numerous small trades to capitalize on minor price movements. Traders utilizing scalping aim to scalp small profits consistently throughout the trading day. Unlike other day trading approaches, such as trend following or momentum trading, scalping relies on the sheer volume of trades rather than the magnitude of each individual trade. Section 2. Core principles of scalping. Price action analysis. Scalping is heavily reliant on price action analysis. Traders closely monitor price charts, looking for minute fluctuations and patterns that can signal potential entry and exit points. The ability to interpret price action in real time is a core skill for successful scalpers. Execution speed and technology. Given the need for quick decision-making, execution speed is paramount in scalping. Scalpers often leverage advanced trading technology, including direct market access (DMA) and algorithmic trading platforms, to gain a competitive edge in swiftly executing trades. Tight spread and liquidity. Scalping is most effective in markets with tight spreads and high liquidity. Tight spreads reduce the cost of each trade, and high liquidity ensures that orders can be executed without significant price slippage. Major currency pairs and highly liquid stocks are often preferred by scalpers. Section 3. Common scalping strategies. Market-making strategy. Scalpers employing a market-making strategy capitalize on the bid-ask spread by simultaneously placing buy and sell orders. Profits are generated as the scalper captures the difference between the buying and selling prices. Breakout scalping. Breakout scalping involves identifying key support or resistance levels and executing trades when the price breaks through these levels. Quick trades are initiated to capture rapid price movements following a breakout. Range trading. Range-bound markets provide opportunities for range trading scalpers. In this strategy, traders identify price ranges and execute trades at support or resistance levels within the range. Scalping with indicators. Technical indicators, such as moving averages, Bollinger Bands, or the Relative Strength Index (RSI), can be incorporated into scalping strategies. These indicators help traders identify potential entry and exit points based on specific market conditions. Section 4. Advanced scalping techniques. Time and sales analysis. Scalpers often use time and sales data to analyze the order flow in real time. This detailed information about executed trades helps in identifying buying or selling pressure, aiding in decision-making. Level I quotes. Level I quotes provide a deeper view of market depth by displaying the bid and ask prices beyond the best bid and ask. Scalpers use this information to gauge potential price movements and liquidity. Correlation analysis. Analyzing correlations between different assets or markets can provide scalpers with additional insights. Understanding how correlated markets move can help in predicting price movements and making informed trading decisions. Section 5. Risk management in scalping. Setting tight stop-loss orders. Given the quick pace of scalping, setting tight stop-loss orders is crucial to limit potential losses. Scalpers often adhere to a strict risk-reward ratio to ensure that winning trades outweigh losing ones. Position sizing and capital allocation. Scalpers carefully determine the size of each position to align with their risk tolerance and overall capital. Effective position sizing prevents any single trade from disproportionately impacting the overall portfolio. Adaptability to market conditions. Scalpers must adapt swiftly to changing market conditions. If volatility increases suddenly or liquidity diminishes, scalpers may adjust their strategies or temporarily step back from the market to avoid unnecessary risks. Section 6. Psychological discipline in scalping. Maintaining focus and concentration. Scalping demands intense focus and concentration. Traders need to stay alert and make quick decisions, requiring a disciplined mindset to avoid succumbing to emotional reactions. Handling stress and pressure. The rapid pace of scalping can create stress and pressure. Successful scalpers develop psychological resilience to navigate the emotional highs and lows associated with quick decision-making. Avoiding overtrading. The allure of quick profits may tempt some scalpers to overtrade. Establishing clear criteria for trade entry and exit helps prevent impulsive decision-making and maintain strategic discipline. Section 7. Continuous evaluation and adaptation. The dynamic nature of financial markets necessitates continuous evaluation and adaptation of scalping strategies. Scalpers routinely assess their performance metrics, adjusting their approach based on changing market conditions, technological advancements, and personal experiences. Flexibility and a commitment to ongoing learning are fundamental to sustain success in the ever-evolving landscape of day trading. Section 8. Scalping in different markets. Forex scalping. Explore the unique considerations and strategies employed by scalpers in the forex market. Currency pairs, liquidity, and global economic factors play a crucial role in forex scalping. Stock market scalping. Delve into the intricacies of stock market scalping, including considerations for specific sectors, earnings reports, and the impact of market news on stock prices. Cryptocurrency scalping. Examine the challenges and opportunities faced by scalpers in the cryptocurrency market, where volatility is heightened, and 24/7 trading introduces additional dynamics. Mastering scalping strategies in day trading requires a combination of technical skill, risk management prowess, and psychological discipline. As traders navigate the complexities of executing quick trades and managing rapid market fluctuations, the strategic nuances of scalping come to the forefront. The exploration of scalping strategies is an ongoing journey, where each trade is a lesson, and each day presents an opportunity for refinement and growth in the fast-paced world of day trading. Through meticulous planning, continuous evaluation, and unwavering discipline, scalpers can forge a path to financial prosperity and master the art of navigating the exciting yet challenging landscape of day trading. What do you think of our video? Let me know in the comment section below. If you enjoyed this video, make sure to hit that like button. Also, subscribe to our channel before you go. Thank you for watching.